Good morning, ladies and gentlemen. Well, we closed the week at 75, which is an improvement on last week. But the scores to me are a bit, I don't know, they don't really convince me. Simply because I've examined all the spreads and the improvement is really all due to the fact that the volatility spreads have gone down, while the other spreads, the ones that I think are really important for under the hood state of the market, are actually continuing to deteriorate. So I'm not absolutely convinced by this improvement in the scores, but I respect it, and really they are reflective of what I thought last week, which is that the bond market has become cheap enough to be supportive of asset prices, and that is exactly what we got last week. But I'm still quite wary of getting too excited about what is going on, simply because we are reaching an equilibrium level that will be broken one way or another. There will be either a thrust higher in prices or a thrust lower. We are getting to a pivotal point, a pivotal moment in the market. And I'm always very wary when that happens, because the first move tends to be actually the wrong move. But here we are, 1 week at a time. Let's get it right 1 week at a time. And if we do that, we won't go too far wrong. I will now examine why I think we are at a pivotal moment, and as always, we will start with bonds. Well, the most boring market in the world, which is the 2-year note, has continued to do absolutely nothing last week. But I have my levels. I have the 12.5 basis points on the downside and roughly 18.5 points on the upside. And at some stage we will get the break. Those are the important levels to watch on the outright 2 years. But if we look now instead at the yield curve, the 2s, 10s, we're definitely getting definition here. Very, very soon we will either break below this level, which is 138, 139 basis points, and head towards 125 basis points, or we will break this level, which to me is now pivotal, which is 147, and go to 157 and probably much, much, much higher. It's getting to be one of the two. My preferred one is down, but I'm open to all options. It's unlikely that we can stay in this kind of a range. If we shift this to a monthly view, we can see how far we have come, but we can also see that if we go back far enough, and if we start breaking this level, there is really nothing until we get to 250, 260 basis point differential, which would mean another steepening of about 100 basis points. And that would be very, very significant. That would mean that the bond market is going crazy about inflation. And that's why I always say that the yield curve is the most important thing. The thing that is going to kill the equity market rally is going to be the bond market, nothing else. And at some stage that's going to happen. I'm not saying it's going to happen next week or next month, but that is the thing to watch. The other parts of the yield curve, whether they be 5s 30s or 10s 30s or even 5s 10s, have done nothing this week. I mean, they've basically, this is a weekly chart of the 5s 30s, no change in view whatsoever. 154 basis points to 140 basis points is the pivotal range that we have. Would it be surprising to continue doing this kind of thing over here? No, but that is not good enough. At some stage that breaks down. And when it breaks down, all hell's going to be let loose, because we're going to go all the way down to 190 to 230 basis points. And that is a monster move. This is the one that I still consider a leading indicator, the 10s, 30s, because, as long as 10s, 30s hold in this range, that to me still signifies that the bond market is not too worried about what is going on, is prepared to give the Fed the benefit of the doubt about this inflation being transitory. If that were to start breaking down below this level of 80 basis points, you know that the bond vigilantes are in charge, and that they are seeing that the Fed is actually way, way behind the curve. At the moment, absolutely no alarm bells, but we have our levels. We know what is important to watch. As long, and the basically what's happened is that the market has absorbed the supply and still held in. This is a weekly chart, so we actually improved very slightly in the 5s, 10s last week. I should really put a line here, because this is obviously a very, very important level at 85 points. We start going through 85 points on 5s, 10s, and I think really you are looking for a very, very decent steepening. I think it'll happen all in concert. The 2s, 10s, the 5s, 10s, the whole thing will start breaking down. We have our levels, we know what to look for. In terms of outright prices for 5s, 10s and 30s, very little change last week. We had the high tick was on the open on Sunday night, and we basically improved in terms of lower yields, higher prices ever since then. But as you can see, it's a very narrow range. If you take the 5 days, 1, 2, 3, 4, 5, absolutely no change on the week. And we are just holding this channel between 79 basis points and 89 basis points that we've been in for what feels like months now, and it actually is months. It's all building to NFP end of the week on Friday. Then we have CPI the week after. We have the Fed in June, all building towards Jackson Hole the month after. There's a lot of speculation that Jackson Hole will produce some results, and that could be when the yield curve really starts moving, because if they decide to start ending tapering and actually having a timetable for raising rates, I don't think the yield curve actually will steepen on the end of tapering. I think it will actually come in. Because people will start getting out of the things that are, why would you invest for 2 years at 15, 17 basis points if you think the Fed in a couple of years' time is going to be hiking rates? You would certainly move to a part of the curve that has discounted the tightening, and that is the longer end. And therefore, I think that's why I think the yield curve eventually will come in. But I think the move in the 2s and 5s could be quite violent. And I think the move is up. But that's neither here nor there. When I examine, if we examine the 10s, we'll see the same pattern as the 5s. If I enlarge it, we are 151, the bottom of the range. If we start breaking through 169, something is going on, and we are going quite a bit higher. This could be, this is some sort of a bull flag, and that is all that can be said about it for the time being. And very much the same thing in 30s, whichever way round you look at it, whether you look at it in terms of yield or terms of TLT, where are we? I mean, I prefer to look at it in terms of TLT here, where we are basically doing another one of these. Here, we're just letting the moving averages catch up, and then we are ready for a big move one way or another. So really, everything is telling you the same story. We probably have stability here for another few weeks, maybe 2 or 3, and then, but when the move starts, it will be very, very violent. The European market has actually been the one that's been easiest to forecast and easiest to trade. It goes to levels almost to the tick, and this is the bobble, the 5-year. The targets were achieved, it's backed off, and now it's going sideways. I think this area between 58 and down here to 61 is going to be very, very difficult to break on the downside. This is a wonderful area to accumulate shorts in bobble for another move later on, I believe. If we have a look at Germany 10-year, much the same thing. We backed off to nearly 22. I think we'll probably see it again, and this is going to be a very difficult area to break on the downside. And even if we break it by a few ticks, I really don't think it goes much further than -24, -25. This could be an ABC down to -25, 6, 7. But this is going to be a wonderful area to accumulate longer term shorts in Bund for another move up to the targets. If we, Italy's also been, very rewarding, got out, boom. I'm definitely interested in getting short again of Italian bonds around 82, 83, maybe this kind of level 80. But this channel here, is this an ABC that's going to come down towards 79, 80? Quite possibly. Very interested in being short at these levels again in terms of BTP futures. France, much the same thing. Traded beautifully up to the target. A, B, C come down, fill this gap to around, what is this, 5 basis points, maybe down to 4 basis points. It all looks at that level wonderful for a retry up towards the 29 area. I really don't have a problem with any of those. I'm definitely looking to re-establish shorts in all of those. If we look actually at the spread between the German 10 and the Italian 10, coming back in towards the 108 area, that area should prove interesting. 108, 107 should prove interesting for another move up in yield differentials. And the one that gives me a clue that I'm right in my view that eventually the Europeans will start going up, because I think the US is going to go up. You get a, is this pattern that I'm getting here, this stability around 174, 175 basis points. I think that we are very much stuck in a 5-tick range here between US and Germany for a long time, which really tells you that you should be looking for levels to re-establish shorts in bunds, BTPs, OATs. Those levels that we just looked at are going to be very significant, and the likelihood, the risk reward at those levels is extremely compelling. what to say about the most frustrating market in the world, which has been foreign exchange in the past few months. And that is, that it cannot break significantly higher than 91.01, and it's just not breaking below the 89.80 to 89.41 band. I think this kind of frustration is going to continue, that people are going to get stopped just as they start to force a range. Don't force the range. There is absolutely no reason for it. You can see how long it traded in this kind of pattern on a weekly chart. That is months, isn't it? That's like a whole quarter of trading before it made a move. Most probably we get the same kind of thing here. That's all that there is to be said, and it makes sense if as I showed you, the differential between the 2 10-years is stuck at around, give or take 5 basis points, around 175 basis points, then why should FX move considerably out of that range? If we have a look at what that looks on Euro USD, you can see on the weekly chart here that basically the Bollinger Bands are coming in. Would it be a surprise if we traded between 120 and the highs of 123, 125 for another 2-3 weeks? No, absolutely not. So the risk reward is basically to stay short of volatility, stay short of puts down here. If the primary move is still one of up, and therefore being short of puts, it should be profitable. I really don't see anything much to do in this market, and I leave it alone. The gold market has given you your first warning that it's changing, that it's becoming bullish again. We are now at the top of the weekly Bollinger Bands as opposed to at the bottom of the weekly Bollinger Bands. It's been quite a move, but the pattern on the dailies suggests a period of sideways trading, trying to change the 200-day moving average again. If we enlarge this, we can see that the 200-day moving average is still going south. But I think that this market is now going to be very, very well supported anywhere around 1810, 1820, 1830. I really can't see it lower than that, because if it goes lower than that, then I have to start changing my mind about what bonds are going to do, what bond yields are going to do, and what the dollar is going to do. And since I see the dollar as stable and bond yields not really keeping up with real inflation, then I still have to be giving gold the benefit of the doubt. And below this kind of level, this 1810 to 1820 area will be my warning that something is changing. Until that happens, I think it'll be, any consolidation actually is going to be healthy. It's going to turn the moving averages and give gold time, because it needs now time to 2 or 3 weeks sideways, and then it can actually start forcing the Bollinger Bands just like it did here, and continued for many months afterwards. To me, the primary impulse of gold is still one whereby the real rates are going to go down, i.e. stay negative, i.e. real inflation goes higher than the move in nominal rates, and therefore that gold is going to be supportive. And all the spreads that I'm now going to show you point that way. The inter-market spreads, this is SPY over GLD, and this is IAU gold over TLT. GLD, IAU, very much the same kind of thing. This is just suggestive to me that gold is entering the middle of the butterfly, that more people are buying it. And really, you'll remember this level at 0.216 that we talked about when it broke this level late last year, and I said, well, it's going towards this level, 29. We've gone a long way. We still have about a 10% swing to get to it. All suggestive that gold is going to outperform bonds, and it's beginning to outperform equities as well. These are weekly charts, so you have to remember that these are, this was a decent sized move a couple of weeks ago that gold put in against equities. So a couple of weeks of sideways is really no big deal. I still see that gold is going to outperform equities and bonds over the course of the next few months. Overall, it seems to me that gold is definitely moving towards the center of the butterfly of the three assets, and therefore I think that any dip down towards that 1810, 1820 area is going to be very, very well supported. What do these spreads imply longer term? They imply that bond rates are not going to keep up with real inflation, and that equity growth is not going to be as high as basically the differential between bond rates and real rates. So to me, that still signifies that in no way is the market committed to inflation being truly transitory. That's all I can say. The market is not convinced, and price definitely is saying that is not going to be the case for much longer. It could easily be that we have a sharp spike in inflation in the next few months, and that is what the gold price is started, and the relationship between these spreads is beginning to indicate, or continuing rather to indicate, because this is a move, don't forget, that started here, which is, sort of July, August of last year. So in no way is this something new. This is just a continuation. The market continues to discount higher, real rates of inflation. When will we get a signal that the market is really worried about inflation and real inflation and accelerating inflation? Well, probably when copper gold falls out of this channel between 158 and 375. When we start breaking this level, I think the market will be screaming for higher rates throughout the yield curve, especially at the short end. It will be demanding the Fed take some action and hike short-term rates. That is my guess. At the moment, we are certainly indicating that we have changed regimes from a deflationary regime to an inflationary regime. Now a period of stability in this range, and then if we start falling out of this channel, then the market will be definitely looking for higher rates everywhere. And that is not, if it gets it, that won't be good for gold, but I think we still have a really decent period of gold outperformance over the course of the next several months. In terms of DBC, we're still holding where we should hold, but I just want to make you aware is that between these areas, this level and that level, 24.39, there is nothing but air. You can see how in what is this, 3 months. We just went one way in commodities back in 2014, and at some stage I have no doubt that we will probably do the same in terms of 3 months, and that will put huge pressure on the Fed to act. Just like it put pressure on them to act here, it'll put pressure on them to act when it does the opposite. And that is, to me, that is more than certain. Is it going to happen now? I don't think so. I think we still have a period until Jackson Hole that the market can go sideways and catch its breath. It would make to me much more sense that commodities start screaming when the situation is more than apparent that something is very badly wrong and the Fed is very, very behind the curve. I don't think they're going to be able to do that. They're going to be in a position to scream higher until that becomes obvious. SPX is, there's only three things you need to know about SPX, and that's 4068, 4129, 4179, 89. That is all you need to know. Is it closing above or below? End of story. You can see how beautifully it's been trading those levels. All dips to those levels get bought. And when it doesn't hold, it goes to the next level and holds there. So, what more is there to be said about this market? It's really going nowhere and has gone nowhere since the early part of April. We are within 0.5% of where we were in the early part of the middle part of April. And therefore, there's really nothing more to be said. I think what I said last week is that you buy every single support level until the weekly closes below this band of 41.28 to 41.15, 14.82, whatever it is. When that happens, this whole trading range will be trapped. I don't think it's going to happen anytime soon. I think we've got another couple of weeks at least of going sideways to up. But I'm prepared to be flexible. I don't see why it should happen, but you can see by the bunching of these moving averages on the dailies that as soon as we take out that weekly range below 41.28 to 41.15, a mass of people is going to be trapped, and it's going to be very, very ugly. I have an idea why it would become ugly. It's not my favorite scenario. For the time being, I am in the camp of the very uncomfortable longs. I am fully invested because the market is doing nothing wrong. I don't like being fully invested, but it's profitable. I think the market is expensive, but so what? It's been expensive for such a long time. Why should this be the top? I don't know, and therefore I will continue being long with 1 foot out of the door. I am looking for reasons not to be long, and I know what that reason is, and when that reason is, that is when we close a week below this 41.28 to 41.40. That's all I have to say about SPX. At some, where's the top? Who the hell knows? Could this be some kind of a bull flag on the weeklies? Of course it could be. The market's crazy and it'll get you to do stupid things. All I know is that if we close above, 42.35, which is the highest, or whatever that level might be, I'll actually try and put it in. Whatever this level here might be, 42.32, that's the highest weekly close. We start, going up through it, there'll be a scramble, a 50-point scramble from all these people caught short in here, and that will just take it higher. Do I think it makes sense to buy these levels? Probably not, but as a trade with a tight stop, it's not a bad one. All you really need to know about SPX, this area, this corridor here, to me is absolutely crucial. It's interesting how 13,717 in NASDAQ is such an important swing level. If you look at it, we haven't done anything since middle of February in NASDAQ. We've been down a bit, up a bit, down a bit, up a bit. It's doing absolutely nothing. It's interesting also to see how the Qs, which is basically NASDAQ, are holding this moving average on the weeklies. I think that's going to be very, very pivotal. I think it is going to, as important as that corridor around 41.28 to 41.15 in the S&Ps. And basically the NASDAQ has been neither the leader nor the laggard. It's doing nothing. It's, closes the spread sometimes, goes back out. Very uninspiring market. And the fact that it's so uninspiring, even when bonds are doing something, doing slightly better, tells me that there is no conviction in the bond move, and there is no conviction in growth. And I understand that lack of conviction. I'm very much in two minds most of the time. And I think people are just basically trying to make, whatever they can make, 100 ticks, and they're out. They really don't have that much conviction behind their opinions. And I know why that is happening, and that is happening because of this. Apple and Amazon. I mean, this is Apple. This is the 200-day moving average. It's just sitting on top of the 200-day moving average without any conviction. If could this be interpreted as some kind of a bear flag and we are just about to break down? It could be. All I know is that markets don't tend to stick around the 200-day moving average for very long. We have been on top of it for, what is this, best part of 3 weeks, and we just can't get away from it. A market that can't get away from, the moving average tends to break it. That's been my experience. And the same thing can be said for Amazon. Here it is, sitting right on top of the 200-day moving average, and really doing the same kind of bear flag pattern as Apple. Now, if these stocks, Amazon and Apple, which form such a huge percentage of the NASDAQ, are doing that, what is the NASDAQ supposed to do? It just tells me that these stocks are going to determine the direction of travel for the next 1,000 points in NASDAQ. It could be very easily could they do a thrust higher, and then you don't see NASDAQ for 1,000 points. But what I'm trying to say is that they are the indicators. Why are they the indicators? Because the other big stocks, things like Facebook, completely different pattern, right? But it's getting overbought. What does that mean? That means to me that if Apple and Amazon lead to the downside, Facebook could easily come off, down to here and still be bullish. It could come down to 270 from 330, and that's like 20%, and still be bullish. And the same can be said for Google. So the market could go down a long way, and this is Google. Google could come all the way down here to 2,100, call it, from 2,300, and that's 10%, and still be bullish. So what all these individual stocks are telling me is that you could get a pretty substantial move to the downside in NASDAQ without most of its components being, seeing anything but a mild setback ready for another run higher. That has to be worrying, because that will mean that bond rates are screaming higher. The only reason that I can think why Apple and Amazon would go down, and you can see how much lower they could go. An ABC could take them all the way into this channel, this area here, say, just north of 100 again. There's a potential for a 10% move in NASDAQ quite easily, and that has to be on the back of bond rates. It can't be on the back of anything else. Europe, and especially stocks rather than DAX, is looking much better to me than the States, and I'm happy to be overweight this part of the market. Now, what do I think is going to happen here? I think it's quite easy to tell from this chart that this kind of level, as I mentioned before, 4,100 odd, is the level that's going to be very hard to break in stocks. If I enlarge that, it's traded very well in this kind of ascending channel. It tends to go up and break it a little and then come back. So that's another 3%. So that would indicate that S&Ps at some stage break that 42.32 level and everything goes into a UP kind of time, and that is the top for quite a bit. So I'm still long. I still intend to get out around 4,100 to 4,130 area. That is where I abandon my stocks longs. And if I look at the DAX, it's the same kind of pattern here. You can see how long this goes on for decades. Anything above here, this kind of area, 15,700, I don't really want to know about DAX anymore. And it's very interesting that all these things, and with EWU, i.e. the UK, stuck around 34.10, that it's all happening at the same time. And it's all happening at the same time as EEM is making a bit of a thrust higher, and I think it'll probably trade at some stage over the next couple of weeks 55.83 or slightly higher, and that might be the top. So, it's getting to the end of the run in the equities. No way can I be positive that it's the top, but you just feel from all these markets, from EEM and from the stocks getting to targets or very good resistances, from DAX getting there, from EWU getting there, that we are within a few percentage points. Now, the one that could start getting interesting actually is Nikkei. This level, 26,940, is the level that we closed the year, and you can see that really we've done nothing but go up in sort of January enthusiasm and come back down ever since, but it won't break the lows. You can see how the weekly Bollinger Bands are closing in. Is there a chance that we take out this 30,205, which is the highest weekly close? Yes, get everyone long and come back down. It would all come together with Jackson Hole and higher bond rates that then turn the equity market. Quite possible. It's a narrative, it's an idea, not something that I'm married to, but something that gives me food for thought. I still think that we will see new highs in stocks, in DAX, in Nikkei, quite possibly. I don't think we'll see new highs in EEM. If we go back to that chart, I think we will just see above 55, 56, maybe up to here 57. That will be it. And then all these equity markets will have food for thought just ahead of Jackson Hole and the possibility of a big change in interest rate regimes. The one market that is telling me there is nothing much to worry about in the very short term is volatility. You know, I think we will continue to trade all of next week, certainly until NFP between 2005 and 1558. And that is a market basically which is suggesting that the S&P can maybe retrace down to that 41.28 area. But that is all it's going to do in the 3 days, sorry, before NFP, and quite possibly in the almost 8 trading days. What is it? 8 trading days before the CPI, so it's a market which is telling me that it's any kind of big move in S&P to the downside is not imminent. And here are all the levels. I've changed nothing much in 2s, 10s or 5s, 30s because there's not much to change. The levels are so clear and so important, that I can't overstress them. I've changed nothing much in DXY, and I've changed the levels in gold, but I've given them. I really don't think we go below 1820 for any reason in the near future. I think any kind of a dip down to 1881 now is probably a buy. So I think it's going to be a very quiet week until NFP in bonds and in gold. SPX. All you need to know are these levels. Any kind of close above 42.33 on that 195-minute chart produces a scramble. I don't think it's going to happen, certainly not for the first couple of days of trading. At some stage they will try and force it for sure, but I think it happens on Friday for NFP or it happens the week after. NQ, I've showed you what I think. I think closes above 13,717 on a daily basis are very, very important. If it keeps on failing there, I think, that's why I put Apple and Amazon here and the levels. If it keeps on failing at that level, that means that Apple and Amazon are actually more likely to break onto the downside of that formation we looked at. And if that happens, then NASDAQ is going to get hit for 6. I have no idea why that would happen, but I'm watching it, and that's all there is to it. All the other levels are here. VIX, while it stays below 2005, I think the likelihood of substantial pressure, certainly below this 41.29 level in SPX is very, very unlikely. So basically you buy the dip first to 41.80 with tight stop, doesn't work, 41.29 will. All there is to be said about that market. Now Nikkei is the one that I'm looking at, and the Europeans. As I said, I think there's quite a good likelihood that we fail overall at the levels that I just mentioned. So I'm looking, if it closes above there, to probably get short. In the meantime, I'm still long, so just playing the range. Thank you very much indeed, and tweet you on Monday.